Hey, how's it going, guys? Welcome back to the Module 1 of Options Trading Foundation, the complete options trading course for beginners. Module 1 is all about options trading basics. In this video, sub-module 1.5, we will discuss the option Greeks, which is another crucial topic that every beginner should understand before start trading options. Alright, let's get started. In the previous two sub-modules, we mentioned that there are three key factors that affect an options premium: the intrinsic value, the time value, and the implied volatility. If this is your first time watching this course and have no idea what are these factors, I would highly recommend you watch the previous two videos before you continue studying this module. Otherwise, it will be very challenging for you to understand option Greeks. Alright, let's continue. Under the intrinsic value, there are two main ways to affect options premium. First is the changes in the price of the underlying stock. Second is the rate of change in the underlying stock price movement. A rate of change basically measures how fast the price changes. For time value, it's the changes in the time remaining of the option contract. And lastly, the changes in the implied volatility will also affect options premium. We have already discussed all this in the previous modules. The main reason we need to fully understand how these factors work and how they can impact the price of options is for the risk management purposes. In fact, because they're so important in options trading, the professional traders even specially assign each one of them with a Greek alphabet. Delta measures the changes of the underlying stock price. Gamma measures the rate of change in the underlying stock price movement. Theta measures the changes in the time value of the options, and the vega measures the changes in the implied volatility. These are called the option Greeks. So in the future, whenever you hear someone mention option Greeks, especially when it comes to options trading strategy designing, you should know that they're referring to this four risk management matrix. I will go through each of them one by one in much more detail. So now let's start with delta. As mentioned earlier, delta measures how much or how large the underlying stock price changes in a certain time frame. The value of delta is from -1 to +1. For call options, the delta value will be positive, anywhere from 0 to 1. The delta value being positive means that when the stock price goes up, the call option premium will go up as well. The higher value of delta, the more sensitive the option is to the stock price movement. For put options, the delta value will be negative, anywhere from -1 to 0. When delta is negative, that means whenever the underlying stock price goes up, the put option premium goes down. The lower the value of delta, the more sensitive the put option will be to the stock price changes. Let's take a look at a quick example. There are two call options for Apple stocks. One is on the money call option with a delta value of 0.25, and the other one is in the money call option with delta value at 0.8. For every $1 increase in the price of Apple stock, the out-of-the-money call options premium will go up 25 cents, and that in-the-money call options premium will go up 80 cents. In general, those in-the-money options will have higher value in delta than out-of-the-money options, which means when the options are in the money, they are more sensitive to the price changes. As the options get further and further in the money, the delta value will get closer to 1 for calls and closer to -1 for puts. When the option's delta value is at 1 or -1, it means this option behaves exactly like its underlying stock in terms of price movement or perfectly inverted, with no time value at all because all of the option's value will be intrinsic. For those at-the-money options, they usually have delta value around 0.5. For both calls and the puts, the delta value tends to increase when they get closer to the expiration date. There are mainly two ways the professional traders use delta in options trading. First, delta is commonly used to quickly determine the probability of an option being in the money at the expiration date. For example, a call option with a delta value 0.2 has roughly about 20% chances of being in the money at expiration, where another call option with a delta value of 0.95 will have a 95% chance of being in the money at the expiration. Second, delta is also used to design trading strategies and measure the risk of the strategies. Those strategies with a high delta are more suitable for high-risk, high-reward strategies with a low win rate. Those with low delta are more suitable for those low-risk strategies with a high win rate, but the potential return can be very limited. Next option Greek, let's take a look at gamma. What gamma measures is the rate of change in delta, or the underlying stock price changes over time. Since delta values are constantly changing with the underlying stock prices all the time, using gamma to visualize the rate of change or how fast the underlying stock price changes is a great way to provide traders the idea of what to expect in the near future. the value of gamma is at the highest when the option is at the money. When the option is deep in the money or deep out of the money, gamma tends to have very low value. Also, those options with longer time tend to have lower gamma values as well. In options trading, gamma is often used to determine the stability of delta. In other words, gamma is the best way to see how reliable the delta will function to predict the probability of an option reaching the strike price before expiration. For example, there are two options that have the same delta value, but one has a higher gamma and one has a lower gamma. The option with a higher gamma will have a higher risk because a negative move in the underlying stock will have a much bigger impact on the option's premium. If delta shows traders the probability of being in the money at expiration, then gamma shows how likely that probability can eventually play out before the expiration. Usually traders use gamma with delta together to measure the potential risk and design trading strategies. Alright, now let's move on to the next option Greek, the theta. Theta measures the changes of time value, or the rate of time decay in the option's premium. There's an interesting fact about the value of theta is that it is always negative for long positions. It's simply because time moves only in one direction, which is forward. So the time value can only decrease as time passes. Theta value tends to go up when the expiration date comes closer, because as mentioned back in module 1.3, time decay will accelerate when the option gets closer to expiration date, especially in the last 30 days. The best way to understand how theta and the time value works is to use this hourglass as the metaphor. The moment an option contract is established between a buyer and a seller, the time value will start flowing. Because the time only moves towards one direction, the time value of an option contract only moves from the buyer side to the seller side. We can say that theta always works in favor of option short sellers and works against option buyers. So whenever you design a trading strategy using options, theta, or the time decay, is one of the most important factors to consider when it comes to choose long or short options in your strategy. Great, now let's move on to the last option Greek, the vega. Vega measures how much an option's premium will increase or decrease due to the level of implied volatility changes. Higher volatility makes options more expensive because when the underlying stock price moves with much bigger magnitude, there is a greater chance to hit the strike price before the expiration. When options are near the money or at the money, they have the highest vega values because they're the most sensitive to implied volatility changes. Longer dated options tend to have higher vega values than those which are near the expiration month. In other words, the value of vega will fall when the options approach their expirations. Vega value can increase or decrease even though the underlying stock price doesn't move at all, but it works differently when you trade different directions. For long options, your position will have a positive vega value. It means they will benefit from a higher vega value. So the best time to build up your long position is when the vega value is low, because lower premium means the lower cost for your long positions. On the other hand, for options short selling, your position will have a negative vega value. It means they will benefit from lower vega value. So the best time to sell or short an option is actually when the vega value is high. Higher premium means more instant profit. So these are the four most important option Greeks that every beginner should understand. In the future, you might hear someone talk about the strategies like a delta neutral or theta neutral strategies, then you will know what that means as an option trader. Alright, now we have completed the entire module 1, the options trading basics. Hope you guys learned something valuable. Let me know in the comment section below if you have any questions. In the next module, the entire module 2, we will move on to the next level, and we will learn how to use option risk graphs or the profit and loss graphs to help your options trading. If you are new to this channel, my name is Vic. I hope you guys enjoyed the course so far. If you find my contents have been valuable to you, please consider subscribing and helping me click the like button on this video. It can really help reaching out to more people who need this content. Also, please turn on that notification bell so that you will never miss any module in the future whenever I upload. Again, thanks so much for watching guys, and I'll see you guys in the next one. Bye for now.